My name is Gabriel Sacks. I'm one of the managers of Asia Focus Investment Trust. We are a trust that has been running for about 25 years, focused really on finding the best quality small caps and tomorrow's winners in the Asian region. With regard to winners in the portfolio, there are really two options that we can take when we see share prices rally. One of which is really to let our winners run, which is a key driver of alpha generation or generation of return to unit holders. And the other option is to either exit or reduce that position by selling. There are several examples in the portfolio of companies that we've been letting run, primarily because the investment case remains intact and valuations haven't really approached territories that we feel concerned about. So, if that re-rating or that share price performance has been driven primarily by good earnings delivery, and there are no real changes to the fundamentals, we would typically let that position run. On the flip side, when we see opportunities to buy things cheaply and something has run quite fast, driven by sentiment, and valuations are looking a little bit detached from what we think is fair value or historical levels of where that company has traded at in the past, then we feel it's prudent to take some profits. So we're always debating those two scenarios and what to do with our 50-60 holdings. We introduced two Vietnamese companies, one of which is a company called FPT Corp, which is a conglomerate in Vietnam, but that is primarily involved in IT services, with also businesses in telecommunications and education. We haven't sold a single share of that stock since initiation about 4 years ago, despite the stock tripling in value. So I think it's a clear example of a winner that we've been letting run. The company has been delivering very consistent earnings growth of around 20% per year. So most of that performance has really been driven by earnings growth rather than valuation multiple re-rating. At a similar time in 2019, we also introduced a company in Korea called Park Systems, which is the largest holding in the portfolio, just under 5% at the moment. They've developed new technology in their machine tools that is sold to some of the world's leading chip manufacturers. And they've got some of the world's most powerful microscopes in those machine tools. Again, that's a company that we've largely let run. We have taken a little bit of profit this year, but that company has quadrupled in value over the last 4 years or so. They are creating a new market, and therefore we think that the runway for growth is really exciting, and they're still in the early stages. So it's important for us to not cut that stock too early. Obviously, not all stocks go up in a straight line. And I think another example of a company that we've let run recently, but one that we added on weakness, is engineering research and design company in India called Cyient. That business suffered some serious setbacks when their aerospace clients went into trouble as a result of Boeing 737 MAX issues and also COVID. But we decided that that was an opportunity for us to buy more of the company, and since then, I think from its lows, that business has risen sevenfold, and I think we're up 3 times on our book cost on that company. So, I think it's an example of where we've backed our holdings and let the company run more recently since it's been recovering. But equally, there are times when it is important also to take some profits. And more recently, we have seen a pretty significant re-rating in AI-related tech names in Taiwan. So one of the companies we own in the portfolio is a company called Sun & Wealth, which has tripled in value just over the last 6 months. It was trading very cheaply on almost single-digit price to earnings multiples and over 6% dividend yield. But after tripling in value, that dividend yield is now less than 2%, and the stock is over 20 times PE. So we have been cutting that one a little bit more than we do with our winners. We're still optimistic about the fundamentals for that business. Essentially, They do cooling fans for servers, for the hyperscalers, Amazon, Microsoft, etc. So they're an important part of the supply chain for high performance computing. And therefore, I think they are seeing a mix shift that is benefiting margins, and they're also seeing decent volume growth. But again, we think that for that business, the re-rating there has been a little bit too fast, too soon. We recently visited India in June with a colleague of mine who's based in Singapore, Sin Yao. And one of the key takeaways from that trip is that corporates on the ground are extremely bullish on the growth outlook and extremely positive on the actions that the government has been taking to support growth, primarily via investments in infrastructure. So we really think that the Modi government does or should take credit for being able to implement structural reforms and increase the tax base. So tax revenues have been increasing 20%, over 20% year over year. And that's been allowing the government to fund investments in road, railways, and also in the energy transition. A lot of the companies we met during the trip were industrial businesses, and it was clear that these companies are doing everything they can to benefit from the China Plus One opportunity. So they're seeing very robust demand domestically, but they're also trying to capture more of the export market and gain share in global manufacturing. So a couple of holdings that we hold in the trust, Syngene is a contract research organization. It helps global pharma companies research, develop and manufacture drugs globally at a reasonable cost. And they are primarily constrained in terms of capacity because demand is extremely strong. And they see an opportunity here for India to become more of a hub for drug manufacturing. Clearly, India has a long way to go to become as sizable and as efficient as China as a manufacturing hub. But lots of the companies we met are clearly seeing positive steps towards achieving that goal. Another company we met during the trip is a property developer called Prestige, and that business is really excited about consolidation opportunities in the market. So a few years ago, the government has been implementing regulatory reform, which has been driving the bad actors or the informal sector out of business, and it's really creating more business for the formal players or the listed developers. And Prestige is extremely excited about the opportunity to become a pan-Indian developer and grow in a market where affordability for residential property is at all-time highs, driven by good income growth and actually reasonable mortgage costs, which is the exact opposite of the situation that we have in more developed markets like the UK and Europe, where inflation is high, property prices are high, and rates are also going up. So from that perspective, India is an extremely good place. And the trip was good evidence of what we feel is one of the strongest macro stories across emerging markets, but also globally. And India has been the top position or top market in the portfolio at around 17%. And we see that going higher over time. One of the risks, I suppose, or one of the negative takeaways from the trip is that valuations are relatively high. The small to mid-cap space in India has done pretty well. So we also need to balance our excitement with relative valuations, which, if you compare India and China at the moment, for example, there is a pretty stark difference there in valuation. So, I think what we're doing at the moment is really building a pipeline of ideas that we can jump on should valuations or markets present an opportunity. We feel very excited about the opportunity for Asian small caps going forward. And if you'd like to find out more and see details and fact sheets and all the literature that we produce on the trust, then please visit our website or click the link on the screen.